Welcome. This is the ESOP Guy. We are on a journey to an ESOP. Welcome to our podcast. For those that are joining for the first time, this podcast is really for those that are thinking they might want to use an employee stock ownership plan. It could be that they're wanting to build their succession plan. It could be that they are working towards an ultimate exit. I know a lot of companies that use an ESOP just for simply the tax benefits to help grow the business and retain a lot of the capital. So there's a lot of different ways to use it. So this podcast is really there to help you navigate through maybe all the questions that you might have through for an ESOP. And so if this is your first time joining, again, thank you and welcome. If you have questions or want to look at our other episodes, please go to our website at journeytoanesop.com. So today's topic, I think is a fairly important one. And I will say that I haven't really touched on this much, just because the main focus of our podcast has been on the journey to an ESOP. But a lot of times I'm getting into these conversations with people as we're in the middle of the ESOP process. And so I think it's really important. The topic today is going to be considerations for your post ESOP. And that just basically means, what should you be thinking about once the ESOP actually closes and transacts? And so to do that, we're going to interview Katie Hardin. She is with our firm, Berman Hopkins, and Katie and I have worked together for many years. She's a big part of our ESOP team. She has extensive experience at working with ESOP companies, and really for us, she manages through the multiple compliance areas that are really sometimes complex. And I think for me, there's certain things that I'm an expert in, and there's other things I'm not. Mostly what Katie does is what I'm not an expert in. So getting her opinion or her experience is going to be really, I think, worth it as you go through the process of listening to this episode today. Her experience includes ESOP accounting, which is absolutely necessary, and it's not super straightforward. She also works through managing the on the ESOP company side, financial statement audits or financial statement reviews, to help companies work through that whole process. So again, you may have already had an audit or a review prior to an ESOP, but there are things that need to be considered after you set up your ESOP. She works actively with board of directors for ESOP companies, and mostly in that space, she's presenting the board of directors, the financial statements, anything that she's seeing, and gets engaged in conversations about trustees, gets engaged in conversations about all sorts of things. So we're going to get into some of that. I think that's going to be pretty interesting. And then the other part is just auditing ESOP plan documents, which is a requirement. If your company has an ESOP, you're going to have a retirement policy compliance requirement that you're going to have. And it's different for each company based on the size of your company. So we're going to get into all of that today. So again, thank you so much, Katie, for joining the podcast. Why don't you just kind of give us a little bit of your background in the ESOP world?
So I'm a senior manager here at Berman Hopkins, and I've been with the firm for about 13 years. And I work with several employee-owned companies, and it really is a whole picture type of relationship when we're working with employee-owned companies, because you really have two different entities to be considered here, and that's the company itself, and then also the ESOP, which has its own compliance requirements as a standalone entity. So my background is really working with companies to understand the accounting, but also understand the compliance, because there's a lot of DOL and IRS rules that play into how these things are accounted for, and the different audit requirements, review requirements. And so that's really what my space is just understanding those compliance requirements and working with clients to make sure that they are meeting all those compliance requirements, but also understanding the accounting behind it as well.
Yeah. So how did you ever, was your dream when you were a kid to become an ESOP expert?
No.
No, that's good.
I've always been kind of a nerd. And so really one of my favorite parts of accounting and working with clients is really taking complex accounting issues and and breaking them down and making them understandable and attainable for my clients. Not everybody's as nerdy about stuff as I am. And so the ESOP space was a very natural place for me to go because the accounting and the compliance requirements are pretty complex. And the clients that we're working with are not necessarily technical accountants. They're CEOs and managers and, construction managers, right? These people who are taking over the ownership of these companies. And so it's just been very natural for me to use my skill set as really a technical guru and bring it into a space where people can understand what's going on with this ESOP and really understand the compliance requirements without having to be the same level of nerd that I am. So
yeah, well, I think what definitely separates you from other nerds, I'm not going to be mean to you, but is that you do have the ability to kind of understand the technical part of it, but been able to relay that to people in a way that they can understand, because it's hard enough to deal with all the other financial statement tax requirements in any company, but layer in the ESOP stuff. And so you need somebody that can really help, just explain it in layman's terms is kind of what I'm saying. So you're great at that. And it really helps that. So when you think about this topic and this issue, how important is it, or in your opinion, as we're going through the ESOP process, for people to be thinking about the compliance area and really, what's going to happen next? And I know some people, a lot of my clients, really range. Some people are super nervous about it and, a lot of anxiety. Others are like, well, we'll just get there when we get there and we'll take care of it. How important is it for people to be thinking about that, as they go through the process?
I think it's really important. Obviously, I work on the backside of these transactions. And so I think it's the most important thing to think about, right? I think one of the most important things that people can think about as they're going into these transactions is who's going to be kind of your champion, or who's going to be the person who's really worrying about compliance, accounting, things like that on the backside. And they might not necessarily be deeply involved in the transaction itself, but really having that person who knows, like, hey, on day one, we have these things to worry about. We have all these notes to consider and all of these compliance requirements to consider, and we need that person to be ready to really take on that project of understanding and moving forward with the plan once it's in place.
No, that's excellent. I mean, we're not even getting into the topic yet, but just starting off, I think that's a really good idea. I see that champion sometimes being the controller or CFO. Who do you see that being normally?
That normally is who it is, just because they're going to have a little more technical knowledge of the accounting behind it, or they're going to be able to get there with the technical knowledge. Mm-hmm. But, sometimes you don't have a person that's extremely technical in the group, or, sometimes that person is maybe the person that's trying to leave. So, I think naturally someone kind of rises to the top during the transaction a lot of times. And so that's the person who's really keeping up and really understanding the transaction as it's going. And so really just making sure that person understands that, there's more to it after the fact.
Yeah, I think it's a good point. And we're the process that we go through. I know that for me, advising a client, we're likely going to be identifying some of those key people early on, and just so that you can kind of, as the owner, maybe as the selling shareholder, maybe has anxiety related to it, getting them up to speed. Sometimes Katie and I'll have questions from owners really early in the process, and we'll start dealing with it. But I think that's a good place to start. What are the things that, if you think about, for brand new ESOP companies, so these are companies that weren't ESOPs, they become ESOPs. In your experience, what should they really have to deal with first related to when I say the Department of Labor, DOL, and Internal Revenue Service? What sort of things should they be thinking about at the very beginning of their timeline?
I think the first thing post-transaction that someone would really need to focus on, this is a little outside of the compliance space, but making sure you have a solid team of people who are going to help you understand what those compliance requirements are. And so having that independent trustee, having a TPA who really specializes in, ESOP transactions and ESOP plans, and any other advisors you think you need. Of course, you want to have a good accountant who really understands ESOP accounting, but really just having those people in place. There's a very specific timeline for filing and making loan payments and all of those requirements. So first step, get that team in place and understand the timeline. Usually with your plan, you're going to have a little bit of time before you have to do any filings with the DOL, filings with the IRS, anything like that. So getting that team in place is really key.
Yeah, I agree with that. So, and one thing that I would add to that is those team members like the TPA and the trustee. One of the things I'm looking for from the TPA is to help them publish a timeline for the client specifically, so that, and the timeline itself would be, this is what you're going to do, client, this is what we're going to do as the TPA. And it just breaks down all of those tasks. And part of it too, that my experience is there's some non-compliance things too that you're going to want to naturally do. And that's like planning your rollout meeting. How are you going to tell the employees? All of those things are going to be somewhat important. When you get to the first real DOL or IRS requirement, what are you seeing in that regard?
Generally speaking, one of the first DOL requirements you're going to see is that there is a tax return, the Form 5500, that's required to be filed by the plan itself. And so a lot of people think, oh, well, this is a non-taxed entity, so that's it. They're done with the IRS, and that's not true. And then, of course, there's a lot of compliance requirements as far as communication with your participants. And that really is an excellent tool in relation to what you're talking about, and that rollout and getting employees excited about this new opportunity that they have. And so you want to make sure that that conversation that you're having with your employees is really flowing into those communications that you're having with them officially through your DOL requirements, because it really shows them like, hey, this is real. This is a real opportunity. This is real stock that I own in the company. And so even though it's a compliance requirement, it can be a really powerful tool related to this communication as well.
Yeah, for sure. Let's dig into that a bit deeper too, because as we start thinking about it, we can kind of categorize some of these. When we think about the ESOP as a retirement plan and it falls under ERISA, there are specific requirements, like you've mentioned. It's going to have to file the 5500 tax return. What other requirements would you have? Let's just say that company, in addition to that, regarding the fact that it is a retirement plan, if it's got, in excess of 100 employees, and how does the kind of getting into the whole audit side of the ESOP plan?
That is the magic number, is if you have over 100 active participants in the plan, you will probably have an audit requirement. And so from a compliance standpoint, it's important to remember that you really have two entities now. You have the company, which may require an audit or a review, probably a minimum of a review for your annual valuation. But then you also have this ESOP plan, which is a standalone legal entity. And so if that plan has more than 100 active participants, then you will be required to have an audit of the plan itself. And that audit will need to be attached to your Form 5500 that goes to the DOL each year. Something else I just want to point out about this, a lot of people don't realize that those 5500s and the audits that are attached to them are out there for the whole world to see. The DOL, public. Those are all public records. So that's just something to keep in mind, is that, when you're doing this audit, it's really out there for people to see.
Yeah, just like the 401k that you're probably used to doing. When we say ESOP audit plan, what we want to make sure we do is we really define that that's an audit of the actual plan itself. So a couple of questions about that, and just, thoughts or whatever. What happens if I'm over 100 people and I don't do the audit? What happens to us as a company, or whatever that hypothetical company might be?
So when you're going to file your 5500, it's really easy to tell when you need an audit, because if you file a short form versus a long form, the long form requires the audit.
Mm-hmm.
And so if you do file that 55 or the 5500 with the DOL and you don't have an audit attached, you're going to get communication back from the DOL letting you know that your filing is incomplete. And so from there, generally they give you some time to fix the error or fix whatever it is that you're missing, but you don't want to ignore it for sure, because it's only a matter of time before the DOL loses patience, and then you start getting into fines and penalties, and those get real ugly real fast.
Yeah, we've had some clients like that come to us where they have not been in compliance, and then the thing is trying to get them caught up as soon as possible, because the fines and penalties are very punitive, and you just don't want that. So partly nobody wants to be outside of compliance, but it's just kind of one of those things where people might think, oh, I didn't do it, what happens to me next? So
the other thing
go ahead.
The other thing to make sure of is, don't be afraid of the DOL. If you find yourself in a position where, oh no, I didn't realize I needed an audit, we're short on time, the DOL actually wants people to do things the right way and wants these plans to be in compliance. And so they have some voluntary correction plans that you can get involved with that helps mitigate some of those penalties and fines. So if you find yourself in a situation where there's going to be some type of non-compliance, especially with the filing, there's things you can do to mitigate those things. You don't want to just ignore the problem and not reach out to somebody who can help you with some of those voluntary correction plans.
Yeah. Just a kind of a basic question, but the professionals that do the 5500s and the audits, are they primarily CPA firms?
The audits, for sure. The audits are independent audit reports. You have a CPA firm would have to do that audit. The 5500 is generally prepared by your third-party administrator or TPA. And so that audit process, your auditor and your TPA should be working very closely together, and it should really be a joint effort between the two. Your TPA is really keeping track of your individual participants and how much stock they have, how much money they have in the plan. And that's part of the audit process, is we're making sure that your participants have what they should have, that their stock's being allocated properly. Mm-hmm. And so if you have a quality TPA and you have a good CPA doing your audit, they're gonna work together directly to make sure that those records are correct. And you just want to make sure that you're involved in the process, so you know that everybody's doing the things that they're supposed to be doing.
Let's just say, what happens if your CPA doesn't have a lot? Maybe they do pension plan audits, but they don't do really any ESOP plan audits. What would you say the company should do or look at? Because I'm just kind of throwing it out as a loaded question, in the sense that that could be a problem, right?
Yeah, absolutely. I mean, if you obviously we go to conferences, we have a lot of experience with ESOPs. We're specifically going out and, always getting training on what the most up-to-date information is on ESOPs and ESOP accounting. And the ESOP audits and ESOPs are a very high risk area as far as the DOL is concerned. And a lot of the reason for that is because there are, unfortunately, CPAs out there that are doing audits of ESOP companies and also audits of ESOPs to go with these 5500s that don't really understand the complexity of ESOP accounting. And so if you are working with a CPA, maybe they're doing your 401k, but they don't have any experience with ESOPs, it might be a good idea to just make sure that you at least have an advisor who does understand ESOP accounting that you can turn to as just a double check.
Yeah, just to maybe review it. I know, like for us, one thing that comes up, and I get dragged into it every year, is the ESOP auditor should review the business valuation every year, which is one major difference between 401k plans and an ESOP plan. Is you have an independent valuation firm providing the valuation to the trustee reviews it, but as part of the ESOP audit, we're reviewing it as well, just to see consistency from last year, other things like, did this person have the qualifications, to do the audit or to do the valuation? So I know that needs to be, part of the ESOP audit engagement. Is there anything else that's specific and distinct from the 401k?
Well, the valuation, understanding the value of the stock is huge. We're very fortunate here because our team is so robust and we have a valuation person that we can, go right down the hall to if we have questions.
He's running right now. Yeah, but it is an important aspect of it. Is there anything else that gets done on that, or is it a lot more similar to a 401k?
No, coming back to that allocation, how stock is allocated to the participants is very unique.
Okay.
In a 401k, people are putting their own money in. Maybe they're getting a match from the company. They're putting it into their account. It's very easy to line up one-to-one. These stock allocations that are happening in the ESOPs are complicated, and they're really married in with the corporate accounting side and what the contributions are and things like that. So those allocations can be complicated. And if you don't understand the plan document and really be able to read into it and determine how that allocation should be working for your plan specifically, it's going to be difficult to understand what it is you should be doing as part of the audit.
Yeah. So let's go. That's a great segue into this other part of I wanted to get into is, so we're going backwards a little bit, and we've closed the ESOP deal. And now, again, compliance requirements. One of the things I know we get into is looking at the loans. And when I say the loans or the notes, I mean the outside notes, which are the notes for the companies borrowing the money from a bank or from the sellers. And then the inside notes, which is the ESOP entity, are buying the stock from the company. So we have these two different types of notes. So go into that a little bit as far as booking those notes correctly, because going backwards, it's like one of the first things we do is we'll look at the plan document, or I'll have you look at it and make sure that you have all that figured out in terms of making sure it's all set up correctly.
I'm glad you brought this up, because this is by far one of the most confusing topics. When I'm talking through people and talking through their transaction, this gets confusing really fast. So there is two different notes, and it's important to understand that in most ESOP transactions, there's really two pieces to it. You're buying the stock back from your owners, and sometimes the company's buying that stock. Sometimes the ESOP is buying that stock back, but it's being bought back from the owners. But then there's a transaction between the company and the ESOP to sell that stock to the ESOP. And so that outside note is when you're pulling in the stock from your outside owners. And then your inside note is when you're selling stock between the company and the ESOP. And so I think the reason it gets confusing is because these are two separate entities. And we stress that a lot, like you have your company and then you have your ESOP plan, and those are two separate entities. However, on the accounting side, GAAP really considers them to be related parties and related in a very unique way. And so the reason it gets confusing is because that outside note is very traditional. Maybe you owe a bank, maybe you owe the former owner. It's recorded as debt, and that's very, very typical and understandable by people that might not be familiar with the accounting. But that inside note, that loan that's happening between the company and the ESOP, because GAAP considers those related parties and really interrelated parties, it's not recorded as a note receivable from the ESOP. It's really recorded as a portion of your equity. And we refer to that as unearned ESOP shares in the equity section of your balance sheet. And that gets really confusing because you have this note that you have to contribute, and then the ESOP is going to pay it, but there's no note from an accounting perspective to apply that to. And so that is one of the more difficult concepts to really understand, and GAAP makes it difficult because it really, you have to think about it as two separate notes, but from a GAAP perspective, you really don't see two separate notes on your balance sheet.
That's correct. And it's hard to kind of just talk through that without people asking more questions, because I can imagine if somebody's hearing this for the first time, it's like, what do you mean? And so let me go backwards a little bit. When Katie says GAAP, she means generally accepted accounting principles. And I say that because I know some people probably are not the financial people. And so that just, and other people that are, they're like, hey, that's obvious. But GAAP is what we have to follow when we're doing the financial statements and making sure that they're put together correctly. The complicated part of this is you have this idea that you have a note that has these payments. Now, the inside note, the payments on that inside note are really there to mechanically allocate the shares. The money actually does go into an account, and it comes right back into the company. So it's really a non-cash outlay. But the outside notes are actually going to get paid like other debt. So it's just going to be like any other debt that you might have that the company is going to owe. So those are distinctly the differences. But what happens is the balance sheet for an ESOP company does have to show, as Katie alluded to, like it's going to show the debt for those outside notes, and it's going to show this unearned ESOP account, which is going to be a negative amount. And so those are going to take a balance sheet and really make it look really, really not as good as it did before. Right, Katie?
Yeah, absolutely. And you kind of get, this is getting into the nerdy stuff, but you kind of get a double negative hit in your equity because you have these big loans to the outside owner, and that is a deduction of the equity in the company to take out these loans. But then this unearned ESOP shares, like you said, is negative equity. So that's also hitting your equity in a negative way. So just another, when you're gathering that team of experts, one of the most important things that you can do with that team of experts is use them to make sure that the banks that you're working with, your surety agents, anybody who might be looking at your financial statements is really going to understand what the effect is on your balance sheet before that transaction happens. Because the last thing you want to do is make your balance sheet look really gnarly and then send it to your banker and they weren't expecting it.
No.
Or they don't understand it.
Yeah. And then kind of our standard process when we do ESOP work and the ESOP process is to go ahead and do a pro forma balance sheet. And then way early in the process, go over that with the bank, go over that with the bonding company, whoever might need to see it, just so they can see the impact of it. And there's going to be different ways to look at the balance sheet if you have subordinate debt to the bank, but at the same time, it's still under GAAP. There's nothing you can do. I mean, it will look like that when the financials are put together. So the advice here is do a pro forma balance sheet as you go through the process. Share it early on with your third parties that you're relying on, and make sure that works. And sometimes we do that and we're like, hey, let's go back and change the way we're structuring the ESOP. It may be better as a partial ESOP so that we have less of an impact on that balance sheet in stage a transaction as opposed to doing 100%. So there's a lot of ways, but we don't want to be doing that at the last hour when we've all set it all up, or we don't want to have any problems after the ESOP is set up. So.
Well, and I know I'm kind of encroaching into your territory as far as the transaction, but that's why it's so important to really start thinking about this early, because if you're working on your ESOP transaction and you have a few years before you're looking to retire or make this change, then you have the option to do that staged transaction rather than just having to do 100% right away.
No, that's a good point. So another segue into the inside note, and this is going to get into another idea, bigger picture idea for people to be thinking about post ESOP as considerations, is what repurchase liability is. And when I mentioned the inside note, what I was saying before, the inside note is going to provide the methodology of the allocation. So it'll be like, if it's a longer term inside note, 30 years versus a 10-year inside note, that means those shares are going to be allocated on a 10-year note a lot quicker, so that people will build a lot more shares too quickly. So a lot of times that inside note is stretched out longer so that we can manage repurchase liability. But what I want to get into now with Katie is just like, because she's done a lot of work with the board of directors. So, and I want to set it up correctly. So like an ESOP that sells the controlling interest of the stock is going to have a board of directors generally with at least one independent board member. An ESOP that sells a non-controlling interest is going to have a board of directors, but it won't necessarily have an independent board member unless that company just wants one. In addition to that, the board is also interacting with an ongoing independent trustee. It's very common. Now, in Katie's world, what she's doing is she's going and presenting to the board of directors. And what I thought would be helpful is just kind of talk a little bit about your experience in talking to the board. What sort of topics do they kind of focus on? And I kind of teed up repurchase liability because it's a major one. But just going into that a little bit would be helpful because people are like, what's the board looking at normally?
So there really is a life cycle to ESOPs. And so starting at the beginning, if you have a new transaction, the role of the board is really to oversee and make sure that that transition is happening the way that they need it to be happening for their company. And so much of that, as you said earlier, has to do with the communication and really getting the idea of the ESOP out there to the employees and making that cultural transition. And so from a compliance and accounting perspective, early on in the ESOP life cycle, that's 0 to 3 or 4 years, the board is really focused on making sure the compliance stuff is happening. Of course, you want to make sure that all of the compliance work is happening correctly and that you have that great team of advisors in place. But really, their focus is on getting the ESOP going.
Mm-hmm.
Usually, and so backing up, when we're talking about repurchase obligation, that comes back to the idea that over the life of this inside note, you're allocating stock to your participants. And then someday they're going to retire. And when they do retire, the company has an obligation to fund the buyback of their stock so that they can take their retirement in cash. And so that's referred to as our repurchase obligation. Usually in the ESOP world, you have a few years of a buffer between the transaction and when those repurchase obligations are going to start. It's usually written into the plan document. But once you get into year 5 and beyond of your ESOP, you're really going to need to start thinking, and the board of directors specifically is really going to need to start thinking about, okay, what's the long-term picture here? And so the repurchase obligation is not necessarily going to kick in year 5, but the reason it's important to start thinking about it at that point in time is because it might kick in year 8, and you want to make sure that you have the cash available for that repurchase obligation. And potentially you want to make sure you have that cash already in the plan. Mm-hmm. There's a lot of different ways that you can go about these repurchase obligations. And there's a lot of decisions, of course, that need to be made because of the different options. And so asking questions like, is the company going to be buying the stock back or the plan? And then if the company is going to be buying the stock back, how do we get that stock back into the plan for future employees?
Mm-hmm. Yep.
There's also a lot of questions around once you get into year 5 and beyond, if you have a lot of employees who are no longer with the company who are holding stock, you have options to really get that stock back into the hands of the company or get that stock back into the hands of the plan so it can be reallocated to the participants that are current employees. Mm-hmm. The last thing you want is to have your stock be appreciating and employees that don't work there anymore reaping the benefit of that. So those are the types of overarching issues that the board should really be paying attention to at that part in the life cycle of the ESOP, is really start thinking through what are these decisions that are going to be made.
Yeah, exactly. And it sounds kind of like, as you think about it from just common sense, the board's going to be concerned about what affects the company from a financial standpoint, for sure, like a cash flow standpoint. So clearly the repurchase liability is a cash flow obligation. So it would make sense that other things like the warrant coming up and being and maturing and managing the outlay of paying off the warrant is going to be an issue. As other things too, like that. I mean, so I'd imagine like your experience with working with the boards is just you're in a, like you said, you're in a life cycle. So at what stage is the ESOP company if it's starting out? But if mature ESOP company, you're probably going to be more engaged in a lot of these conversations.
Yeah, absolutely. Because there's a lot of really proactive decisions that need to be made.
Mm-hmm.
I'm glad you brought up the warrants and the SARs. That's another thing that people don't necessarily consider when you're really first making that transition for a plan. From an accounting perspective, the accounting for those instruments starts right away. You might not be thinking about the obligation, the cash obligation that comes with those until 5-10 years, whenever they might mature or be available for a follow-up transaction. But from an accounting perspective, they got to get recorded. And those are things that are going to get trued up every year too.
So real quick question on that side. So but the company doesn't in that fiscal period owe anything on the warrant or the SAR, how is it not, it's not treated as a liability, or how is it treated? Or is it just footnoted?
In the initial couple of periods, they're probably not going to have any value. Mm-hmm. But oftentimes they are going to be treated as a liability before that cash obligation is actually due. Okay. And there's going to be compensation expense that's going to be recorded in the periods leading up to when the cash liability is due, which is a good thing, because the last thing you want to do is have a $5 million warrant come due and you didn't have it on your balance sheet and nobody knew it was coming. So
no, that would be bad. Yeah, I think that's a great point, because I think there are people that have questions about, the impact of that, going forward, and how that again comes back to, just like we were talking about at the beginning of booking your transaction, it comes back to what your balance sheet's going to look like,
Mm-hmm.
And so if that's going to affect the balance sheet, the bank's going to have to need to know and understand the way that warrant and the SAR are structured, in the end, at the end of the day, where that liability will actually come to be owed, and the company will have this big cash flow responsibility or cash outflow responsibility. So,
and it can be difficult because oftentimes that obligation is going to come due just as you're starting to also have this repurchase obligation come due. And so you don't want to be surprised by that stuff. You really want to start thinking about it earlier.
Yeah. Well, one point I'll make as we kind of finish, because I know we're getting close to the end of the time, is, one thing that happens in almost every transaction I do is that we end up negotiating at some time period when the company is going to have a repurchase liability study. It's pretty much built in all the term sheets that I'm working on now. And it makes sense because, the company, of course is going to want to do that. But at the same time, the fact that it's mandated in the negotiation and it's a requirement, just like an independent board member or whatever other requirements we have, is good. It's good for everybody, because we want, at the end of the day, even though we're selling, we still want a sustainable ESOP company that can make sure it can pay all of its potential obligations that it has coming down the road. So that's just kind of a point to make when we look at the idea of repurchase liability. That's a lot more orchestrated.
The other thing to consider is, on the flip side, again, another compliance requirement is related to, there are limits on the amount of money you can put into the plan each year based on your payroll amounts in the company. There's a 25% limit. So if you do need to get some cash into the plan for a repurchase obligation very quickly, you have that 25% limit that you have to deal with. So it's just, there really is so many compliance requirements, and you really have to look at the whole picture. Mm-hmm. And so again,
and that's a good point. Because now that we go into, one application of that for an existing ESOP company is, now that we go into a potential recession, you have like just this hypothetical scenario of, hey, the company had to lay off some people, so payroll has shrunk, but they also have repurchase liability, and they have to contribute more to the plan, even though they might have the cash to do it. If you run into that 25% limitation, that can create a problem. So planning is really important. So when a company goes through the process of, say, hey, we got to lay off people, at the same time, they got to look at all of those all the angles of a business decision that can be a lot more complex. So having an experienced ESOP team of people on that board and advisors is really quite critical to being a successful ESOP company. So I think I don't know if you have any more to say about that part, but I think that just brought up in my mind.
Well, the only other thing I was going to say is just kind of bringing it back to the beginning is that's why it's so important to have that champion and that person really thinking through initially the ESOP transaction, but knowing that it's going to be a long-term commitment for them to really understand the obligations of the ESOP and be able to bring that information to the board. Because oftentimes your board members are not CFOs, not controllers. They're not necessarily going to have that in-depth knowledge.
Yeah. And you should definitely get that as a company from the trustee, from the TPA, from your ESOP attorney, from, of course, your advisors at the outside level too. So I think that's a good place to end, because I know we could go into this topic for a long time, but I think those things are really important. I think what Katie and I were doing is really just stressing some things that need to be thought of and don't get really talked about a lot in the beginning steps, but I think they do come out as we go through the whole process and actually do the closing. So with that, Katie, thanks for your time today. I really appreciate you jumping on our podcast, and I think it was very helpful with what you have and experience to share all that. So,
well, thank you for having me. This was nice.
Great. So for everybody else, thanks again for listening. If you like the podcast, please subscribe, share it with a friend. Go to our website at journeytoanesop.com to check out all the episodes. And with all of that, thank you again for listening. We look forward to our next step on this journey to an ESOP.